A very good evening, friends. So I welcome you all to the classes of ICAI conducted by the Board of Studies. And today we've got some very interesting standards to cover. Yes, you heard me correct. We've got some very interesting standards to cover. I am going to cover two standards with you today. One is Ind AS 10 that talks about events after the reporting period. And we're also going to talk in terms of Ind AS 8, which talks about changes in accounting policy, accounting estimates, as well as error. So first, we're going to start a discussion with reference to Ind AS 10. And then after we finish with Ind AS 10, I'm going to take you to Ind AS 8. Now, first, I think before we start with Ind AS 10, let me just tell you that since you've all cleared your CA intermediate examination, you might have already covered a standard when you were in the intermediate, and that is Accounting Standard 4. Trust me, there is not much difference in terms of what you've covered in Accounting Standard 4 as well as on the Ind AS 10. But of course, we need to understand this standard in a more detailed manner, because when you are doing these standards from the point of view of CA Final, the focus has to be quite clear. And since you're already aware that there will be a couple of MCQs which will be asked in the examinations as well, I guess the conceptual clarity you need to get on the standard has to be quite of a high order. So what we're going to do, we're going to start with the standard with you, and I'm going to take you on a run through with each and every step-by-step approach. So as we start with Ind AS 10, hear me very carefully, because I'm going to first of all give you the basic concept. Don't worry on the notes. The notes will be written down at a later stage, and I'll document the notes. You'll get ample time to copy them. In any case, I'll be sharing the notes on the ICAI portal after the class gets over. So you'll be able to get all these notes as well. So do concentrate in terms of understanding the concept. So I think let's begin the journey. And so I'm going to start with, first of all, Ind AS 10 with you. So let me, I think, first of all, focus on the name of the standard. So once again, a very good evening. I can see a lot of my friends. Once again, a good evening, friends, to all of you. Okay, so let's begin with the journey. What I have done, I have taken a little extract of the standard, and I'm going to focus on, first of all, the name of the standard. I hope that's pretty visible enough. Do let me know on the chat box if you can't see it well. Do let me know. So I'm going to first of all focus on the name of the standard. Just see this, hear this carefully. The name of the standard is Events After the Reporting Period. I can see a total of 3 crucial terms in the name of the standard. Whenever I look at any standard, the first thing I always look at the standard is the name of the standard. We're going to spend some time, first of all, understanding the name of the standard. What does Ind AS 10 addresses? So we can see the focus is events after the reporting period. The question, first of all, comes to the mind is, what is a reporting period? So let me just explain. Let me go back and explain something to you. Now see this very carefully. I'm just going to draw, let's say, a simple line, and let's consider this to be a time scale. Let's consider my financial year in question is April 22, and it is ending on 31st March 23. So let's say the company is following the financial year April to March, that is April 22 to March 23. Now, if somebody says that what is the reporting period, I would say this is what we can say is the reporting period. The company is going to make a financial statements. They're going to report the financial statements, and the period for which they are doing a reporting is April to March. So I would say this period of 12 months is supposed to be a reporting period. Now, another question which can come to your mind is, sir, if there is a listed company and it is presenting quarterly reports, are you going to consider the reporting period to be a period of 3 months? Yes. So we can say that if you are doing an annual reporting, then the reporting period is going to be 12 months in this case. There is a clarification which is given in the education material, which is issued on Ind AS 10, though it is issued by the Accounting Standard Board, but I think for understanding the concept, we'll draw references from there as well. So when I say that the company is doing a quarterly reporting, then it makes the financial statements covering a period of 3 months. So is Ind AS 10 applicable to Ind AS 34 as well? Ind AS 34 talks about making interim financial statements. So the answer is yes. Get mentally prepared for the fact that sometimes in an MCQ, the examiner could test your knowledge in terms of asking that is Ind AS 10 applicable only when a company does an annual reporting, or is it also applicable when it does an interim reporting and they're making a financial statements as per Ind AS 34? The answer is a yes. I hope I am pretty clear on that aspect. So the application of Ind AS 10 is applicable to both companies which make annual financials and companies which are making quarterly financial reporting. Okay. Now, it takes me back, whenever I look at this standard, it reminds me and takes me back to the school. When I started my journey in 10+2 in terms of commerce, I very distinctly remember that the teachers used to tell us that when a company makes a balance sheet, the balance sheet is supposed to be prepared as on a particular date. I'm sure everybody knows that. We either say it is as on, or we say is it as at on 31st March 23. And we were also very clearly told that when a company makes a profit and loss statement, the profit and loss statement is always prepared for the year ended. It is always prepared for the year ended. That means year ended 31st March 23. Now, I want you to focus on the name of the standard. The name of the standard says events after. The word is very clear in the name of the standard, events after reporting period, which means that I'm looking at the events which are going to take place after 31st March 23. So the standard is trying to address the agenda that there might be certain events which are taking place after the reporting period. So get this very clear. I've seen one of the most common mistakes we do is that when we look at a particular question or a case study and we are given an event, we always tend to look at an event which might be before 31st March. Please be careful. The very first focus you need to be very careful is that when I'm looking at the application of Ind AS 10, I am looking at the events which are going to take place after the reporting period. I hope I've been able to stress quite well that you're going to look at the events which are after the reporting period. Now, let me give you a background, though I think you all know Accounting Standard 4, so I'm not going to spend too much time explaining you things. But at the same time, I'm not considering that you've got a base on the standard. Now, Ind AS 10 is focusing on the fact that if there are events after the reporting period, the question arises, do you incorporate them in the financial statements for the year ended March 23 or not? Going with the concept that balance sheet is as on a particular date, going with the position that P&L is for the year ended, apparently anybody would say a no. I would say that I'm making a balance sheet as on a particular date. I'm making a P&L which is for a given period. Why should I incorporate the events which are taking place post a balance sheet date? But Ind AS 10 tells us that there could be certain events which needs to be incorporated, and there are certain events which need not be incorporated. So they've segregated that these events which takes place after the balance sheet date are categorized into two. One is called adjusting events. One is called adjusting events, and the other one is called non-adjusting events. Now, how do we decide whether an event is adjusting or the event is non-adjusting? This is something which we're going to cover very shortly. But for the time being, we need to understand that there are two kinds of events. One is adjusting and one is non-adjusting. The moment we decide that the event is supposed to be adjusting in nature, in this particular case, there might be a need to change the asset or liability in the balance sheet. There might be a need to change an income expense in the P&L. Mind the words carefully. There is another misconception which people have got, and that is that Ind AS 10, or maybe you're looking at Accounting Standard 4, is going to impact only a balance sheet. No, it impacts the entire financial statements. There could be an event which takes place after the balance sheet date, and it may affect the asset or liability in the balance sheet, or it may affect an income and expense in the income statement. So this is a standard which impacts the financial statements. It could change the income, it could change the expense, it could change the asset, or even the liability. So another focus point which you need to remember carefully is that when you say it is adjusting event, it has got an impact on the financial statements. The balance sheet as well as a profit and loss account, both of them could be affected because of adjustments. Secondly, if I say that the event is non-adjusting in nature, then in that particular case, I will not make any changes to the financial statements. I will not change the asset liability. I will not change the income and expense. But having said that, in this particular case, we just need a disclosure. We just need to make a disclosure. And this disclosure is going to be made in the notes to accounts. It is not going to change the financial statements of the company, but this is going to be only disclosed so that the reader of the financial statements can understand that what are the implications because of an event which has taken place post balance sheet date. And also remember, this disclosure in the notes to accounts is going to be done only if it has got a material impact on the financial statements. So you mean to say that if the item, the transaction event has got no material impact, you're not going to take even a disclosure in the notes to accounts? You rightly guessed that. Which means every event which becomes non-adjusting in nature may not be even worthy of disclosure in the notes to accounts. It is only if the impact of that item is material in nature that I understand that the reader of financial statements, his decisions could undergo a change because the impact is material in nature, then it is worthy of disclosure. I guess I've said a couple of things in the last couple of minutes, almost, I guess, around 10 minutes. Let's, I think, consolidate the picture. Let me also see if any questions are coming from your side as well, if anything is still bordered at this stage. Okay. Okay. I think Shruti said, make it more visible. Okay, not a problem. Next time, I'm just going to see that. Right now, we just saw a name. That's it. Okay. So I think let's consolidate the picture and then we'll take the journey forward. So what are we studying? We are studying Ind AS 10. So what we are doing right now, we are studying Ind AS 10. The name of the standard, what we are covering, the number is 10. It is called events after, let me put it in short, reporting period. The name of the standard is called events after reporting period. Now we need to understand one simple little thing. I'm just looking at the name of the standard, and the moment you sit down and close your eyes and revise tonight, remember, you should be focusing first on the name of the standard, events after reporting period. So the first question what comes to the mind is, what is a reporting period? As I said, that a company might be making annual financial statements, in which case the reporting period comprises 12 months. There might be a listed company which is doing a quarterly reporting and they are making financial statements covering a period of 3 months. When a company does a quarterly reporting, in this particular case, they need to apply Ind AS 34. Ind AS 34 deals with interim financial statements. It's called interim financial statements. So when a company is going to apply the standard Ind AS 34 to make Ind AS interim financial statements, even then Ind AS 10 is going to be applicable. So we've understood what is a reporting period. So if somebody puts an MCQ, can a reporting period be 3 months? Yes. Generally, it is 12 months. Yes. And then we understood the focus is on the word after the reporting period. So we're looking at the events which are going to occur after the reporting period. So we are yet to decide when an event is adjusting or when it is non-adjusting in nature. What are the parameters to decide? I'm yet to discuss. But I gave you that if you lead to a conclusion that the event is adjusting in nature, it means even though the event has taken place post the balance sheet date, you are going to change the balance sheet asset or liability. You are going to change the P&L, income and expense, and that's what is called adjusting. Change, adjust the items in the balance sheet and in the P&L. And the moment you're going to say that it is a non-adjusting event, in this particular case, you don't need to make any adjustments to the financial statements. It is only going to be disclosed, and that also in the notes to accounts. Unlike Accounting Standard 4, where you've done, it is disclosed in the director's report. But in Ind AS, it is not in the director's report. It is in the notes to accounts. So maybe if you're thinking, Sir, मैंने तो Accounting Standard 4 में director report पढ़ा था. Well, you might have done director report. That was ICAI Accounting Standard 4. But in terms of Ind AS 10, it is notes to accounts 1. And it is only going to be disclosed provided it is material in nature. If it is not material, it's not even worthy of disclosure. I guess if you're absolutely clear, friends, do send me a message. I'll get the signals. I hope the pace is fine. I hope you've understood well. You want any changes on the pace, on my speed? That's my velocity. Or if there is anything which you've not understood, please feel free to ask your questions on the chat, and then we'll take the journey forward. So in the meantime, I'm just looking at if there are any questions coming in. So I think let's take the journey forward. So if you've well understood, just give me a thumbs up or just tell me a message on the chat. We'll take the journey forward with you. Now, moving further, the focus is how to decide that the event after the reporting period is adjusting or non-adjusting in nature. Now, what I'm going to do, friends, I'm going to make your life simple. I'm going to give you a step-by-step approach with the help of which you will be able to easily decide that the event is adjusting or non-adjusting in nature. And I'm going to create a 3-step model with you. And trust me, with that, you're going to do 100%. Okay, I got my answers. Yes, sir, absolutely clear. Looks perfectly now. Okay, yes, clear, pace is fine. Wonderful indeed. That's great. Okay, so I think let's take the journey forward, friends. Now, hear me very, very carefully. When I'm deciding the event is adjusting or non-adjusting, there is going to be a 3-step model. Don't worry on the notes right now. Just look at the example carefully. I'm going to create a 3-step model with you with the help of an example, and we'll take another 1 or 2 more examples to make it perfectly clear. Okay, let's do one thing. Let's take a simple time scale to understand this. So let's consider that I have the financial year, let's say 1st April 22, and the financial year ends on March 23. So undoubtedly, this is a reporting period. Now, let me just give you a basic example with the help of which I'm going to create a 3-step model. Let us consider that on the balance sheet date, let's consider on the balance sheet date, you've got a debtor who owes you a total of 25 lakh rupees. In your balance sheet on 31st March, you are reflecting a debtors at 25 lakhs. Now, let me just extend this time scale. Let us say on 10th April 23. Let's say on 10th April 23, I got an information that this debtor has become insolvent. I got this information, that is 10th April, that the court has declared him insolvent. So the court declared him insolvent on 10th April, which is post balance sheet date. I found out that why he became insolvent. I came to know that on 20th of March 23, there was a major fire. There was a huge fire at the customer's factory, not my factory. There is a major fire which took place at the debtors, let us say, factory. I never knew this. Mind the words, I never knew this. So I was making my balance sheet. I never knew that a major fire had occurred in the premises of my customer. But post the balance sheet date, I came to know that on 10th April, the customer has been declared bankrupt, he's insolvent, and we are also told that nothing is recoverable. He's completely insolvent and nothing is recoverable from him. So we will not be able to recover this 25 lakhs. I think logically, if you ask anybody, on a very logical level, he might decide that in this particular case, let's create a provision because we know the amount will not be recovered. But we need to understand things on a scientific level. Now, let's begin the journey. Now, hear me very carefully on the three-step model. Before you apply the three-step model, in every question, the first thing you need to do, please make it as a practice. Trust me, you're not going to get wrong answer. Before you apply the three-step model, first of all, focus on the point that what is the event? What is the event? Let me ask you a question. Is the event the major fire or is the event the insolvency? Let's get these answers from you. In my example, can you tell me what is the event in my example? Is it the fire? Or is it the insolvency? What is the event? Let's, I think, keenly look at your answers at this stage. So I guess I am getting the very first answer from one of the students out here. That's perfect. It is supposed to be insolvency. Wow, correct. Since the focus is events are after, I think that is absolutely correct. The events after means insolvency is the event. Fire is before. The fire has occurred before the reporting period. That's not an event. The event is supposed to be after the reporting period. So do one thing. First of all, you note down what is the event. So I can say insolvency is supposed to be the event in this example. Now, once you've taken a note of this, and I think everybody is well understood, that's really great. I think everybody is very well understood the word after. I'm sure today when you're going to go sleep and you're going to remember the name of the standard, I will be standing in front of you and, saying the word after. That's great. So I think you've got the focus very clear that the event is after the reporting period. Great. Now, we're going to go step by step and we're going to apply a total of 3 steps. Now, let's see the step number 1. The question arises, event takes place after the reporting period, but there has to be some cutoff date. It is after 31st March, but it has to be before some date as well. So the standard says the cutoff date is the date when the financial statements are going to be approved by board of director. We all know in a practical life situation, before the financial statements are released and they are filed with the regulatory authorities like MCA, Ministry of Corporate Affairs, we all know this, that once the financial statements are ready, it has to be approved, it has to be adopted by the board of directors of the company. So the financial statements of every company has to be first adopted, approved by the board of directors of the company. Then only it can be filed with the regulatory authorities. Now, having understood this part, we can say, let's take an arbitrary date. Let's say 30th September is the date when the financial statements are approved. Now, let me make it clear. In step number 1, you just need to see that is this event between the cutoff dates. I repeat, you just need to see that is the event between the cutoff dates. What are the cutoff dates? It starts on the balance sheet date and it ends when the financial statements are approved by the board of directors. The event has to occur between the cutoff dates. So in step number 1, you're going to focus that does the event occur between the cut-off dates. I'm using the word called cut-off dates. So let me focus on the word. You're going to put across a question that did the event take place between the cut-off dates? What are the cut-off dates? The cut-off date starts on the balance sheet date, in my example, 31st March 23, and the cut-off date ends when the financial statements are approved by the board of directors. In case of company, the financial statements are approved by the board of directors. So let me ask myself a question that did this event of insolvency, which occurred on 10th April, did it occur between the cut-off dates? Yes. If this event did not occur between the cut-off dates, the standard is not going to be applicable. Because there is a cut-off date, we are going to incorporate only events which happen between the cut-off dates, remember. So if the event takes place, not between the cut-off dates, Ind AS 10 is not applicable. Sometimes the examiner could check your knowledge as well. That do you know that the events which are adjusting or non-adjusting have to take place between a cut-off dates, starts at the balance sheet date and ends when the financial statements are approved by the board of directors of the company. So put across a first question, did this insolvency take place between the cut-off dates? And the answer is a yes. Go step by step, no hurry, and you'll get the correct answer. Okay, once you get the yes on the step number 1, you go to the step number 2. Now, step number 2 is a little crucial one. Hear this carefully, because maximum mistake people do is in terms of step number 2. Now, I'm first writing the step 2, then I'll illustrate that step number 2. In step number 2, you need to watch out. Is there a condition? Is there a condition? I'm putting a square against the word condition. Is there a condition that existed? Is there a condition that existed on balance sheet date? You need to put across a question that is there a condition which is present on a balance sheet date? Now you would immediately ask, so what do you mean by a condition? Now hear me carefully. Don't worry, you can write later. Just focus on this. What do you mean by a condition? You need to see the reason of the event. You need to see what is the cause of the event. Why did the debtor become insolvent? Because there was a major fire which occurred in his business premises. If the reason of the event, please mind the words, if the reason of the event is present on the balance sheet date, you may or may not be aware of the event. You may not be aware of the reason. The company which is making its financial statements may not have a knowledge of this fact. It doesn't make a difference. It doesn't make a difference. So as a company, when I was making my balance sheet on 31st March, I never knew that there is a major fire at the customer's premises. That doesn't make a difference to me. It is the presence of the condition which is important. It is not the knowledge of the condition which is important. I repeat. It is the presence of the condition which is important. It is not the knowledge of the condition which is important. I just need to understand that the cause, the reason of this insolvency, which was a major fire, was the condition present on the balance sheet date. If you say yes, the condition was present. So what was the condition in this case? The major fire. You need to simply understand one thing. ये आग न लगी होती ये आग न लगी होती तो ये इंसॉल्वेंट ना होता. ये आग लगी इसलिए इंसॉल्वेंट हुआ. So you need to understand that the cause, the reason of the event, which is the major fire that existed on the balance sheet date. So I say yes, the condition is definitely present on the balance sheet date. Then I go to step number 3. Now you would say, sir, if the condition is not present on the balance sheet date, it is non-adjusting event. If it is a non-adjusting event, it is only going to be disclosed in the notes to accounts, and that also if it is material in nature. I hope I'm clear. So if you say in step 1, the event doesn't occur between the cutoff dates, standard is not applicable. If you say it occurs between the cutoff date, you go to step 2. In the step number 2, you say, is the condition present on the balance sheet date? If yes, I go to step 3. If you say the condition is not present, it is a non-adjusting event. The reason, the cause of the event has to be present on the balance sheet date, even though as a company, I may not have a knowledge of the fact. Then we go to the step number 3, and you need to see, did we get? The third question is, we need to see, did we get evidence? Did we get evidence? Let me square the word evidence. I'm putting some, marks on the important thing. Step number 1, cut-off dates. Step number 2, condition. Step number 3, evidence. So we need to see, did we get evidence in the cut-off dates? You need to get the evidence in the cut-off dates. Mind it, that's also very important. You need to get the evidence in the cut-off dates. That means you need to get an evidence between March and 30th September in my example. Now, friends, evidence and event is same. I made a note of the event. The event which you identify before the 3-step model itself is supposed to be the evidence. When you identify the event at the start, the event itself is the evidence. So the evidence in this case is insolvency. The evidence in this case is the insolvency. So all the 3 questions are in a yes. Did the event of insolvency occur between the cutoff dates? Yes. Was there a condition on the balance sheet date, the reason of the insolvency, the major fire was present? Yes. Did we get the evidence in the cutoff dates, insolvency? Yes. If you say yes to all the 3 steps, it becomes adjusting event in nature. But don't stop at giving a conclusion to the examiner that it is adjusting or non-adjusting. Once you say that it is adjusting in nature, give him the accounting implications as well. It would be appropriate and definitely desired that you should also give him the accounting implications of this particular impact. So what do you mean by accounting implications? Well, accounting implications means tell him that since this is adjusting event, I am going to create a provision for doubtful debts. So we are going to reflect the debtors in the balance sheet at 0 value. And we're going to take a hit in the income statement for a provision for doubtful debts. The company's profitability will go down by 25 lakhs because of creating a provision for doubtful debts. And the balance sheet will reflect a lower debtors to the extent of 25 lakhs. So that is the accounting implications you need to give. If it is a non-adjusting events, I would say it would be a good practice to maybe draft a note to account and tell the examiner that, okay, this is non-adjusting event, so it requires a disclosure. So this is, the way it's going to be drafted. What are you going to see? The study material. you're going to see a couple of examples which explains how the answer is going to be drafted. But I think the best way to do it is, divide your solution into, first of all, the 3 steps, then give a conclusion in terms of adjusting or non-adjusting, and then number 3, give the accounting implications. I hope I am well understood on this example. No worry, we're going to take some more examples as well with you. But I hope I am pretty clear so far, so good with the journey. Did you get the basic concept in hand? So a quick revision and some more examples is going to endorse the things, right? I guess everybody's pretty clear and comfortable so far. Okay, I think Shruti, you've got a question. If evidence is event only, then why step number 3? But I'm just trying to make things a little more convenient for you, in the sense that once you've identified the event, I have indirectly, done my homework for step number 3. You're right that if you've identified the event, step number 3 is not required. So technically speaking, you may not look at the event and directly start with 3 steps. But I would advise it is more good that you first focus on the event. Tell the examiner at the very start of the solution that you've identified that this is the event after a reporting period. Gives a good feel factor, to the examiner as well. Okay, looks good. Wonderful indeed. Clear. Wonderful indeed. Super. So I think let's get the quick inputs at this stage. Then let's take 1 or 2 more examples to understand this further. The standard is pretty easy and not a complicated one. Okay, so let's take the journey forward, friends, with you. And I am now going to just take a quick recap of the inputs I've given you. And then we're going to take some 1 or 2 more examples to understand this bit. Well, I have given you that when you're looking at events after the reporting period, the events are of 2 types. One is called adjusting and one is called non-adjusting in nature. What are the parameters to decide that the event is going to be adjusted or it is going to be non-adjusted? The parameter is you apply a 3-step model. I gave you an example where I said after the balance sheet date, the customer became insolvent. And there was a major fire before the balance sheet date. The company in question never knew. They had no knowledge of the fact that there has been a major fire at the customer's premises. We just came to know after the balance sheet date that he has become insolvent. Now, what you need to do is the 3-step model like this. Before you apply the 3-step model, I would say identify what is the event. Your focus is very clear. The event is going to be after the balance sheet date. Just note down the event. And once you've noted down the event, go on a 3-step model. Number 1, has the event occurred between the cut-off dates? What is the cut-off dates? Starts from the balance sheet date and ends on the date when the financial statements are approved by the board of directors. So you need to see that the insolvency occurred between the cut-off dates. Simple to watch out. And we said a yes. So there are 2 possibilities. Event took place between the cut-off dates. If the answer is yes, go to step 2. If the answer is no, standard not applicable. Then you go to the step number 2 and you see that on the balance sheet date was the condition, the reason of the event present. What triggered the event, the reason for that event should be present, even though the company has no knowledge of that condition as on the balance sheet date. They may become aware later, doesn't make a difference. So if the condition is present, the knowledge of that condition may not be present, then we say go to step 3. If the condition is not there, it's non-adjusting. And step number 3 is going to be simply a formality. You just need to see that did you get an evidence after the balance sheet date that is in the cut-off dates. If you get an evidence, it is adjusting. If you don't get an evidence, it is non-adjusting in nature. Okay. So far, so good. I think I want to now add on a few complicated inputs. Let's take 2 more examples before I give you one of the exceptions applicable to this particular standard. But before we come to the exceptions, let's take 2 examples, slightly more complicated than this one. So let's take a time scale. And I'm going to take your inputs as well. in this example. So let's consider the financial year is April 22. Let's say it ends on March 23. And let me draw a dotted line and consider 30th September 23. This is the date when the financial statements are approved by the board of directors of the company, and this is the balance sheet date. Okay, so let's give you some facts. As I give the facts, try to decide things as well. Maybe you can decide it very well. Okay. Now let's consider the company was making a balance sheet and I had inventory which is worth 5 lakhs. The cost of this inventory is 5 lakhs and the net realizable value of this inventory is 6 lakh. We all know that inventory is measured based on Ind AS 2 and the measurement principle is cost or NRV, whichever is less. So the company would have applied the measurement principles under Ind AS 2. In ICAI, you did accounting standard 2, and in Ind AS, inventory is covered by the standard number same, Ind AS 2. So we say that the inventory is taken at the lower of the two. So we will value the inventory at the lower of the two, that is 5 lakhs. Simple and straight. So the company applied the valuation of inventory principle on the balance sheet date, and they said cost NRV, whichever is less. Please hear this carefully. Let us say post balance sheet date. Let us say post balance sheet date on 12th April 23. This entire inventory is sold. Let us say at 3.8 lakhs. Let us say this entire inventory is sold after the balance sheet date at 3.8 lakh, whereas the cost is 5 lakh rupees and it is sold below cost price. That means at a loss of 1.2 lakh. The company identified what is the reason for the sale at a loss. Why did the inventory sell below the cost price? And they identified that the reason for this is that there is a manufacturing defect. The company identified that there is a manufacturing defect in this inventory, and the company never knew. The company never knew this, that there is a manufacturing defect. They only became aware of this defect after the balance sheet date when this inventory was sold. So when they investigated why this inventory is sold below the cost price, in this particular case, they identified that this inventory had a manufacturing defect, which they were not aware on the balance sheet date, but they became aware only once the item is sold. Now let's begin the journey. I'm going to put across questions, friends, to you, and let's see if you can answer this. Then I think the things are pretty done. Okay, I think Viraj has got a question. So as the situation is clear and no amount is recoverable from the debtor, provision is appropriate or bad debts? Well, I would say bad debts will happen when you're saying that, I am confirmed absolutely that nothing is recoverable. Provision seems to be more appropriate because, the event took place post balance sheet and the cause was present. So provision would mean more appropriate in nature rather than calling it as a bad debts. Okay. Now let's begin with the things. I want your input, friends, on this. Get ready to answer things. Can you tell me what is the event in this particular example? Let's get your answers on that. What is the event in this case? You need to identify. So what is the event in this case? I might be getting a slow answers. Maybe the net could give you slow answers, but let's still wait for your answer. What is the event in this particular example? Is it the sale of the inventory below cost? Am I technically correct that the sale of the inventory below the cost price is the event? Correct? That makes complete sense. Now, I think let's apply the 3-step one by one. Let's put across the questions and let's get your inputs on that. Let's begin with step number 1, then step number 2, and in step number 3. So I think we've got wonderful answers on that. The loss of the sale of the inventory below cost. Wonderful indeed. I'm now going to put across the first question, which I can easily answer. I'm going to ask myself, did the event take place between the cut-off dates? I'm going to put across, did the event take place between the cut-off dates? Of course, yes. The cut-off date is 31st March. It starts 30th September. It ends. The sale is definitely between the cut-off dates. Yes, the sale is between the cut-off dates undoubtedly. Now, I think I need the second input. Was there a condition which was present on the balance sheet date? I am very keenly looking at your answers now. Decide, is there a condition which is present on the balance sheet date? Make your analysis very clear. The cause of the inventory sold below cost is the manufacturing defect. So was that condition present on the balance sheet date or not? So let's get your inputs on that. Can we say that the reason, that is the manufacturing defect, the reason was present on the balance sheet date? It's a manufacturing defect in the inventory. So I guess we've started getting answers. And I think somebody's done good inputs as well. I think good, Mansha. You've given all the three answers. Wonderful. And that's right. Okay, Rajiv, you tell me, no, sir, there is no condition. Now, you need to be careful. You need to be careful bit on this. The reason of the sale below cost is a defect. Was this inventory manufactured before 31st March? Was this inventory manufactured before 31st March? Of course, yes. If it is unsold on the balance sheet date, if it is unsold on the balance sheet date, it was definitely manufactured before 31st March. So was the defect present on the balance sheet date? What do you say? I think I've got the answers. That's right. Absolutely. Yes, the manufacturing defect is definitely present on the balance sheet date. If this item was unsold on the balance sheet date, it was already manufactured before the balance sheet date. So the defect was present. Sir, but I never knew that there is a defect. Does that make a difference to my analysis? No. The defect was there, but I had no knowledge of the defect. That doesn't make a difference. The second step is the presence of the condition. It is not the knowledge of the condition which is important. It is the presence of the condition. I hope I'm pretty clear on that. Okay, that's wonderful indeed. So we can say the condition was present. Yes, it was a manufacturing defect. Let's consider if this defect was not a manufacturing defect. But let's say the defect happened post balance sheet date. Let us say due to some kind of a damage which took place post the balance sheet date. Then was there a condition on the balance sheet date? No. You must refer one of the questions which came recently in the exams. A very good, interesting question on Ind AS 10, where the damage to the inventory took place post the balance sheet date. Let's say there is a heavy rainfall due to which the inventory got damaged. Then the condition was not present on the balance sheet date. But in this case, being a manufacturing defect, it is certainly there. Okay, then we go to the step number 3 and see that did we get an evidence? Well, the evidence and the event is the same. That means the sale of the inventory is the evidence of the fact that it is supposed to be defective. So once you say the answers are yes, it is undoubtedly an adjusting event. So what is the accounting implications of this now? So what is the accounting implications on this case? Shall I reduce the valuation of inventory? Yes. Now you're going to say that the NRV of the inventory is not 6 lakh, but you should update the NRV as 3.8 lakhs. The company should update that the inventory's net realizable value is 3.8. So there is a need to write off. There is a need to write off the inventory by 1.2 lakhs. So the inventory in the balance sheet is going to be reduced to 3.8 lakhs. That means the asset side, the balance sheet will reduce by 1.2, and the company will take a hit in the profit and loss account that there has been a write-off of inventory to the extent of 1.2 lakhs. Okay. I hope, friends, I am pretty much clear on this. So this was a very interesting question. I'm going to take another interesting question with you. But I'm choosing my questions very carefully. I started with a very simple kind of a question, but now I'm going to take you to a little more complicated example. Get set, get ready for this. So you're going to answer this as well. Let's take another example. Okay, so I hope you are able to understand the concept very well. You need to, the only thing which bothers people at time is the step 2. I think step 1 is not a problem because that is just looking at the dates that the event is within a cut of dates. I think step 3 is not a challenge because the event and the evidence is same. The only challenge is in terms of step number 2. So you need to think very carefully and go through the analysis and evaluate that, the reason, which is the cause of that event, that is the condition that needs to be present on the balance sheet date. Okay, let's, I think, take another example. This time you get your turns. Let's consider the financial year is April 22 and ends on March 23. And let's consider the date of approval of the financial statements is 30th September. This is the date when the financial statements gets approved. And let's consider this is the balance sheet date. Now look at the facts very, very, very carefully. Because I think I'm pretty sure this one, I'm going to get some good answers, correct answers from most of you. And I think if you're able to give the correct answers, then I think you've understood the spirit of the standard Ind AS 10. Now watch this carefully as I give you the facts. Let us say on 20th March 23, the company issued a check to a supplier. A company issued a check. The company issued a check to supplier. So they gave a check to the supplier, let's say to the extent of 5 lakhs. Pre-balance sheet date, the company issued a check to the supplier. So what did they do? They passed the entry creditors account debit, and bank account was given a credit, and they did this entry with 5 lakhs. I guess that's pretty much clear. So when they issued a check to the supplier, so this is the journal entry which they did on 20th March. Creditors were given a debit and the bank was given a credit. So this is reducing the creditors in the balance sheet and correspondingly reducing the bank balance in the balance sheet. Okay, let's take it further. Let us say this supplier went to the bank on 10th of April 23. I gave him a check and he went to the bank on 10th April 23 and he presented the check to the bank. He presented the check to the bank on 10th of April 23. When he presented this check, the bank dishonored the check. When he presented the check, the bank dishonored the check. They said the check is dishonored. Reason, wrong signature. The check was dishonored. The reason is there is a wrong signature. Now get the facts very clear and you're going to take a call on this. So let me just quickly add on the facts to you. So we can say before the balance sheet date, the company issued a check to the supplier. So when they issued a check to the supplier, in this particular case, they did the entry creditors debit and bank was given a credit. The check payment was made, reducing the creditors, reducing the bank. The supplier went to the bank after the balance sheet date and the check gets dishonored. When he presented the check to the bank, the reason is the signature is incorrect. Okay, let's go step by step. This time I'm going to wait for your answers, friends, on that because it's going to be very, very imperative. Let's begin the journey and let's get your answers on that. I want you to quickly tell me what is the event in this example. Let's wait for your answer. Decide, friends, what is the event in this particular case. Wonderful indeed. I got the first answer. Wonderful. So let's get some more answers on that. So decide what is the event. You know, the event is always going to be present after the reporting period. So you need to see what is the event. Okay, so I've got one answer, maybe some answers still on a WIP stage, but I'm sure everybody will be able to easily identify what is the event in this case. Yes, I've got wonderful answers on that. Great. So we can say the event is the dishonor of the check. Wow, that's wonderful indeed. So let's apply the step number 1, then step number 2, and the step number 3. And let's see if you can answer this wonderfully well or not. Number 1, did the event take place between the cut-off dates? The first question I'm going to put across is, did the event take place between the cut-off dates? Undoubtedly, yes. The dishonor took place between 31st March and 30th September. So the answer is absolutely a yes. It was within the cut-off dates. Undoubtful. I think that is correct. Wonderful indeed. Okay, I think I've already started getting answers on the other one as well. Very good. Now let's ask you, was there a condition present on the balance sheet date? I am very, very keenly looking at your answers. This decides the final fate of your understanding on the standard. Okay, so I think I got the inputs. Vanshika tells me, yes, there is a condition. And Arisha tells me, yes, there is an evidence as well. And she's already said the condition is there. Janki also tells me, yes, there is a condition. And I think I've got these answers so far. And let's see some more answers coming in. And I think I'm also getting from Yedu, yes, there is a condition. And even Mohammed tells me issuing of check is a condition. But issue of check is not a condition. Issue of check is not a condition. Now let me ask you. Let me ask everybody. The check got dishonored because the signature is wrong. Was the wrong signature present on the balance sheet date? The question is fairly simple. Was the wrong signature present on the balance sheet date? You do the check before the balance sheet date and the check at that time was incorrect. And I think we got some wonderful answers on that. Yes, 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 yes. That's wonderful indeed. So can I say the signature was incorrect even on the balance sheet date? Because when you made the check, the signature was wrong. It did not turn wrong after the balance sheet date. It is the date when you do the check itself, it was wrong. So the condition was present on the balance sheet date. This is one of the very old questions which came in auditing in CA final long time back. So now we need to see that did we get an evidence, and the evidence is the event, and that is the dishonor. The dishonor is the event itself. All the answers are a yes. It indicates it's adjusting in nature. And let me also add on something more, friends, to you in this particular case. Sumit, you said so non-adjusting, even no condition is present. Well, the condition is present, beta. When you say that the reason for the dishonor is the wrong signature, was the signature wrong on 20th March itself? Yes. You need to be sure that the condition is the reason of the dishonor. What is the reason of dishonor? The event wrong signature. Was the wrong signature present on the balance sheet date? It was. Because on 20th March, when you do the check itself, there was a wrong signature. I hope I am clear on that, right? So it's but without verification of bank house signature is wrong at the balance sheet date. But they verified this to you on after the balance sheet date. But was the signature wrong? It was confirmed post balance sheet date. Mind the words. It was confirmed post balance sheet date. But was it wrong on the balance sheet date itself? I made one important input and I said the condition needs to be present. The knowledge of the condition is irrelevant. I repeat, it is the presence of the condition which is important. It is not the knowledge of the condition. You became aware of the fact that there is a wrong signature later. That doesn't make a difference. What is important is that the wrong signature is present. And let me add on something more to make it even more clear in this case. Do you think that the companies could have even intentionally put a wrong signature on the pretext of reducing their creditors and improving their current ratio? Oh my God, are you getting my point? A company could intentionally put a wrong signature with the intention of reducing the creditors. Now you will say, so let us see, is the intention wrong or not? Well, you cannot make any evaluation assessment of the intention. If I start looking into whether the signature was intentionally wrong or not, that's going to be quite risky affair. So all we can say is that the company could have issued, put a wrong signature with the malified intention of reducing the creditors. So when I say that this is adjusting event, what am I going to indirectly tell the company? I am going to indirectly tell the company that because of the adjusting event, please reverse this entry. I will say, please increase your creditors in the balance sheet. Please increase your bank balance, because effectively you have not even issued a check. In this particular case, you put a wrong signature at the very inception. I can't allow you to reduce the creditors. Please restate the creditors back at a higher value. And please change your bank balance as well, because this is an adjusting event. So I think if the company has, malified intentions of reducing creditors, I definitely need to sell them to reverse. Now you say, it was unintentional mistake. How would I prove that? So in any case, unless mentioned otherwise, I'll prove that the signatures are wrong, which is supposed to be technically intentional in nature, right? I guess I am pretty clear on that. Okay, right, Sumit? I guess you got your answers on that. So it was wonderful to see your inputs coming in under the three-step model. And I think the main thing what you need to, get a more expertise is on the fact that there is a condition on the balance sheet date. So I'll just again stress the inputs. When you say condition, you need to be very clear on one aspect. Condition means the reason of the event. Please hear this carefully. Condition means the reason of the event. When I say reason of the event, the condition needs to be present, but the knowledge of the condition is not important. The signature was wrong on balance sheet date. I was not aware. That doesn't make a difference. The fire occurred at the premises of the customer. I was not aware. Doesn't make a difference. The inventory was defective on the balance sheet date, but I was not aware. Doesn't make a difference. I hope you got this point, right? Got it? Wonderful indeed. Sometimes I am in a habit of asking people to do a little self-assessment as well. Because, since we are engaged digitally with you, I can't even look at your faces. And the only way of making an assessment of your understanding is that you make your self-assessments at this stage. If you were to give yourself a comfort zone, let's say on a scale of 1 to 10, regarding the understanding of this standard, let me get your insights on that. How would you grade yourself on a scale of 10 regarding the understanding of the three-step model, that whether it is adjusting or non-adjusting? Let's get your scores. So let's see what is the comfort zone so far. Then I think I'll take the journey forward. So is the standard done? No, I just need to give you one more exception as well. Then we'll push on to the next standard with you. In the meantime, give yourself comfort zones. Don't give yourself a 0. So give yourself a comfort zone on a scale of 1 to 10, and let's see what is the comfort zone on the understanding of this standard. You need to, of course, do a lot of practice. You need to revise things as well. But so far, I think it seems to be quite good. Okay, I think I've got a score of 10 by 10. I got a score of 8. That's wonderful indeed. Super. Okay, we have to get some more scores. You can start punching in your scores. Let's now take the journey forward. Making a self-assessment is a very difficult task indeed. Because, if you need to self-assess yourself, that's the most difficult task. But you should be doing that, because that's how you're going to understand your limitations, what you need to improve, and your strengths, which you can even increase them further. So that's a good exercise to do. Okay, we got some more one, 9 by 10 and 10 by 10 so far, 9 and 10. That's wonderful indeed. That's quite encouraging. But please do revise, do questions from the study material. There are a lot of questions given in the Ind AS 10 in the study material as well. Pick up the past examination questions, practice them as well. You will get definitely a much more good understanding further on this. Okay, so far, so good. That's great. Now, a small little thing further on Ind AS 10, and I'm now giving you an exception. I'm now giving you an exception to non-adjusting event. I'm giving you now an exception to the concept of non-adjusting event. You heard me correct. I'm giving you an exception of a non-adjusting event. So you mean to say that there is no condition which is there on the balance sheet date? Okay, I think Yadu tells me, so you've explained very well. It's easy for us to understand. Thank you, Yadu. Thank you so much. And I think, Mohammed, you tell me. So usually I don't like to rate myself, but now I'm in a position, if someone asks these three conditions, very much comfortable to answer. That's superb. That is superb. I'm delighted to know that. That's great. Okay. So I'm now giving you the inputs in terms of exception to non-adjusting event. So you mean to say that there is no condition on the balance sheet date, but you're still going to adjust? Yes. You've done that in accounting standard 4 as well, but I will just like to give the inputs further on this. So let's consider a time scale in order to understand this example. So let's say the financial year is April 22 and it ends on 31st March 23. And let's consider that the financial statements approved on 30th September 23. I'm just taking the date, just for the matter of convenience. So this is the date when the financial statements are approved by Board of Directors. And that is the balance sheet date. Now, let me give you the facts and we'll understand the exceptions with the help of this particular example. Let us say we are considering there is a major fire. There is a major fire on 10th April 23. This time the fire is not at the customer's place. This time the fire has taken place in your company itself. So we're looking at a fire occurred in the premises of the company itself. It's such a major fire that the company doesn't even know whether they will be able to continue in business or not. In other words, we can say the going concern assumption is taken a hit. The company is not sure because of this major fire whether they will be able to continue the business in the foreseeable future or not. So because of this major fire, there is a question on the going concern assumption. The going concern assumption tells me that the company will be able to continue its business in the foreseeable future. The going concern assumption tells me that the company will be able to continue the business in the foreseeable future, at least for the period of next 12 months. But let's say if I say that due to this major fire, which occurred post balance sheet date, the company is in a dilemma and they feel they may not be able to continue the business. Is there a condition which is present on the balance sheet date? No, the fire took place after the balance sheet date, and due to which they are feeling they may not be able to continue the business. Accounting Standard 4 as well as Ind AS 10 clearly tells me that even though there is no condition present on the balance sheet date, we will still make adjustments. So in this particular case, if the going concern assumption becomes invalid, so let me put it like this. So we are saying if the going concern assumption becomes invalid, if the going concern assumption becomes invalid, so the moment the going concern assumption becomes invalid, in this particular case, it is treated as adjusting event. It is treated as adjusting event even if there is no condition on the balance sheet date. The condition is not present on the balance sheet date, but still it is considered to be adjusting in nature. So the question rises, what are you going to adjust? We will change the assets and liabilities on realizable value approach. We will change the assets and liability based on a realizable value approach. We will consider as if the company is going to go under liquidation. We will assume as if the company is going to go on a liquidation. So we will convert the balance sheet as if, all the assets and liabilities are going to be realized and paid immediately. So you're going to change the basis of accounting. You're going to change the basis of accounting in this particular case. This is the exception to the concept of non-adjusting event. So if there is something which happens post the balance sheet date, there is no condition even present on the balance sheet date, but if your going concern, because of that event, the going concern assumption makes it, invalid, you need to change the base of accounting and adjust the financials. Okay. Lastly, one small clarification. One clarification on the standard before we take you to the next standard. So let's give you one small clarification as well, which I think everybody knows it very well. If a company declares a dividend for the current year in the next year, a company declares a dividend for the current year in the next year, are you going to incorporate that in the financials? No. There is a clear-cut inputs given in Ind AS 10 that if a company declares a dividend for the previous year, you're not going to make any changes to the previous year financial. It's only going to be disclosed in the notes to accounts. Let me put it out here. If a company declares dividend for previous year in the current year. So if the company declares a dividend, we are saying if the company declares a dividend for the previous year in the current year, only disclosure in notes to accounts, is required. Only disclosure in notes to account is required in previous year financial statements. So that's a simple clarification that when a company declares a dividend, so in this particular case, the moment you declare a dividend, we just need to make a disclosure in the previous year financials in the notes to accounts that the company has declared a dividend. It cannot be reflected as an actual liability in the balance sheet of the company. Simple and straight. Okay, so far so good. So I think we are covered with the first standard with you, which is a small little standard, not a very complicated one indeed. Let me see if any questions coming so far on your mind. I guess so far so good. I think that's fine. Okay. Now, friends, I'm going to start with the next standard with you. Sir, so fast. Well, we're going to cover two standards with you. So one standard I've already covered, and I'm going to start with a new standard. I will not give you a break at this stage. Break will be given in another half an hour's time. Let me make some background work on Ind AS 10, Ind AS 8 with you now. And after that, we'll give you some break after another half an hour's time, and then we'll get into some more nitty-gritty. So Ind AS 8 is not also very technical standard. It's a pretty easy standard indeed. So you know what I'm going to do now. So you're going to look at the name of the standard, and you're going to make some analysis on the name of the standard. Wow, you've understood me very well indeed. That's great. Okay, that's so it's a same treatment of final and interim dividend. Interim dividend in any case would have been paid off in the current year. Since it has already been paid off in the current year, it cannot be a subject matter of balance sheet. So what we're discussing is the concept of a final dividend. This treatment will not apply to interim dividend, because interim dividend is something which is declared and as well as paid in the current year itself. So we're looking at final dividend and not interim. Right, beta? Clear on that? Okay. Wonderful indeed. So let's take the journey forward. I've also taken the text of the standard Ind AS 8. So let me just share the name of the standard further with you. So we're going to first of all take you to the name of the standard. I'm just going to have a look at the name of the standard. I hope the heading is visible. Don't worry if other things are visible right now or not. The focus is just on the name of the standard. So hear me very carefully now at this stage. Just the name should be visible, even if the other parts is not, it's perfectly okay. I'm looking at the name of Ind AS 8 and it says accounting policy. Number 1, changes in accounting estimates. Number 2, and errors. Oh my God. This cannot be a chance. Why does it happen with me that every time I take up things, there are always 3 steps, there are always 3 concepts? So, I'm just looking at the name of the standard and it's got 3 agendas indeed. One is accounting policy, one is changes in accounting estimate, and one is errors. So I'm going to explain the 3 concepts to you one by one. Now, let me first give you a thought process how I am going to take you forward in this particular standard. So let me just, I think, first create a small little chart, and with the help of which we will be able to understand what we are going to study in the standard. So please hear me very carefully. So I am going to divide this in 3 parts because the standard is discussing 3 issues. So let's first of all understand what we are going to study in the standard. Number 1, the focus is on accounting policies. The focus is on accounting policy. Number 2, the focus is on accounting estimates. And number 3, the focus is on errors. So we can see that there are 3 inputs which are given in the standard: accounting policy, accounting estimates, as well as errors. The first thing we need to understand on accounting policy is, what are accounting policies? Trust me, I've asked so many people at times when I meet, even when I look at, the working in the industry, and you ask them, sometimes people don't have a definite answer in terms of whether it's an accounting policy or not. Don't take me otherwise, but people sometimes are answering things by fluke. And they just decide, okay, this seems to be an accounting policy, and they're not really convinced with the fact whether it's an accounting policy or not. Today, trust me, I'm going to give you some definite parameters on the basis of which you will understand whether it's an accounting policy or not. So we're going to first of all focus not on the definition, but we're going to focus on the concept in this case and understand what is an accounting policy. Number 2, after we've understood that what is an accounting policy, we need to understand that, can a company change an accounting policy? Can we change an accounting policy? That is a second question. And the answer is definitely a yes. But there are certain parameters within which you can change. A company can change, but there are defined parameters when you can change. You can change, but there are parameters when you can change. Okay. The third input we need to understand that if you change an accounting policy, then how would the accounting be done? How would you do the accounting when you change an accounting policy? And at this stage, I can give you one simple answer. It's going to be retrospectively. Which means that if you change an accounting policy, I will say, you need to go back and see what was the first time you applied the policy originally. So I want you to go back and change the policy with a retrospective effect. So change the policy from the day you started accounting for that particular original policy. So the change accounting is going to be on a retrospective basis. So we will do a retrospective accounting. So 3 agendas which you need to understand. What is an accounting policy? Are we supposed to follow these policies consistently year by year, or can we change an accounting policy? And if you change the accounting policy, in those particular cases, are you going to account it on a prospective or a retrospective? So the answer is it's going to be on a retrospective basis. Next, When you look at the accounting estimates, well, in this particular case, I will not get into the example. I will not get into what is an accounting estimate, but I'll explain you. I'll give you more examples of accounting estimates. Rather than giving you a definition of accounting estimate, I would rather tell you that there are numerous examples where estimates are required. And I'm going to give you examples based on the Indian accounting standard position itself, that what are, examples where estimations are required. The second question is, can estimates change? Can the estimates change? Of course, yes. Estimates are taken on the basis of information available on a particular date. So I am sitting on a particular date. I have a certain data. I have a certain information on that particular date. So we take an estimation based on the information available on that date. So can the estimations undergo a change once more information becomes available? Undoubtedly, yes. So can the estimates change? The answer is, of course, a big yes. Let me make it clear. A change in the accounting policy is allowed only in certain parameters. But estimates can undergo a change. There are no parameters when you can change the estimation. You can say the moment you get new information, the moment you get additional information. So the moment you get additional information, the moment you get a new information, there might be a change which might be required in an estimation. So the question what comes to the mind is the third question, that if there is a change in estimations, how would you account for it? Are you going to do it retrospectively or are you going to do it prospectively? So in this case, the accounting is going to be prospective. In this case, the accounting is going to be on a prospective basis. So we can see that the input is very clear, that we need to understand the examples of estimations. And can the estimates undergo change? Yes, as you get new information, as you get additional information related to, the estimate, you might have to undergo a change in the estimate. And I'm going to do the accounting prospectively. I will do the accounting from the date the new information is available. It's not retro, it is prospective in nature. Then comes the input in terms of errors. Now comes the input in terms of errors, and let me tell you something, friends, which is very important. When I say errors in terms of Ind AS 8, when I say errors in terms of Ind AS 8, errors in this case include frauds. Errors in this case also include frauds. By the way, I have a small little question, friends, coming to my mind at this stage. Let me also ask you in this particular case. Is a detection of error and fraud post-balance sheet date adjusting event? Let's quickly ask you that question. If a company after the balance sheet date locates an error or locates a fraud, do you think it is an adjusting event? You just need to think that there is a condition which is there on the balance sheet date or not. So let's see your understanding, friends, on that. Sumit tells me 3-step model. Superb. Thank you, Sumit. So in this particular case, if there is a detection of error or if there is a detection of fraud which occurred pre-balance sheet date and is located post-balance sheet date, do you think it is adjusting in nature? Give me your input, friends, on that. Let's see. I'm talking of Ind AS 10 right now rather than Ind AS 8. So do you think detection of errors and frauds is going to be adjusting or non-adjusting in nature? And I think I'm getting a mixed response on that. One person said it is adjusting, another said non-adjusting. Had the error already occurred on the balance sheet date? Yes. Was it present on the balance sheet date? Yes. Had the fraud already occurred on the balance sheet date? Yes. Had it already occurred? Was the error and fraud already present? Yes. Did I have the knowledge of the error and fraud? That's not important. I hope you got your answer right. So the moment you say that there is an error, the error took place in the before the balance sheet date, it is detected later. It was already present and detected later. The fraud had already occurred. It was already present. So the detection is done, but the error was already present on the balance sheet date. The fraud was already present on the balance sheet date, right? It would be adjusting in nature. Okay. So let's come back to the concept of errors now. Okay, we got some good answers on that. Yes, it is undoubtedly supposed to be an adjusting event. That's great. I just thought, out of the blue, a question was coming to the mind. Now, let's consider the concept of errors. So in this particular case, again, I will not define what is an error, but I will rather give you examples of what are errors. Well, error is basically a mistake. Intentional, unintentional doesn't make a difference. I said it very clear. Error is a mistake, intentional is a fraud, unintentional is an error. It doesn't make a difference to me whether it is intentional or unintentional. So we'll see some examples on that. And then the question arises that when you detect the error, what should be the accounting of this particular error? So in this case, we're going to cover the aspect of detection of once you detect this error. Rather, let me put it like this: to maintain the consistency of three questions. So let me now ask you, do you need to rectify the error? Do you need to rectify the error in this particular case? I would say yes, provided it is material. I didn't say a complete yes. I didn't say a complete yes. I said, do you rectify the error? I said, I will rectify the error if it is material. So will you rectify the error? Yes, if it is material. So if it is material in nature, I'll definitely rectify the error in this case. And materiality has its own role to play. So now the question arises, if you rectify the error, then this particular case, what is going to be the accounting? Retrospective or prospective? Retrospective. Just like accounting policies are accounted on a retrospective effect, even this will be done on a retrospective basis. So now I think you can understand, I've given you a mind mapping in terms of 3x3 matrix. I've given you something 3x3. You must be thinking, this man has got a favorite number 3. He creates a 3-step model. He creates a matrix of 3x3. Well, 3 is not my favorite number. It's just a matter of chance. 3 is nowhere my lucky number. So let's get the thought process very clear on Ind AS 8. We are understanding 3 aspects of Ind AS 8. Number 1, we need to understand what are accounting policy. Can we change an accounting policy? Yes, there are defined parameters when you can do that. And if you change the accounting policy, it is supposed to be a retrospective accounting. Number 2, what are the examples of estimates? And can the estimates undergo a change? Yes, as new information or additional information becomes available, estimates will undergo a change. And if they undergo a change, will you do retro or prospective accounting? And number 3, when you're looking at errors, we look at examples of errors. It can be unintentional, it can be intentional. A fraud is intentional, but it is considered to be an error. So do the errors need to be rectified? If the material, certainly yes. And what is the accounting? It is again retrospective accounting in nature. So I've just given you a framework of a discussion. So we are now going to discuss number 1, accounting policy, then the estimates and errors. Maximum time we'll be spending on accounting policy, because once we're done with accounting policy, similar kind of accounting applies to errors that will get automatically covered somehow. And in terms of estimations, it's a pretty simple accounting, so that doesn't need much emphasis. So we're going to spend good time on accounting policy. Let's begin the journey. So let me see if there are any questions coming so far. So out here. Okay, I think Shruti, you had a question, but if it is a fraud, it can be rectified? Yes. Rather, you need to rectify that fraud. If there is a fraud, yes, we need to. And okay, Vanshika tells me, sir, indeed, sir, you're making it magically easy. Thank you, Vanshika. That makes my day. And Vanshika tell me, if error is adjusting in material, then rectify is needed. Yes, absolutely. Okay, let's take the journey forward, friends, with you. I'm now going to give you some definite parameters of taking a decision. I know your accounting, your Ind AS journey on financial reporting is just started. But before I explain an accounting policy to you, you need to understand some deep inputs at this stage. So Give me a very patient listening for the next couple of minutes, and you will get the trick of deciding accounting policy. So let's begin the journey on accounting policies. I'm going to give you some conceptual understanding to begin with on accounting policy. I'm taking you out of the standard. So hear me very carefully. I'm taking you out of the standard. So hear me very carefully, because this will help you in understanding even the other asset related standards. I'm taking you out of the standard and I'm taking you to asset related standards. I'm talking of a little on asset related standards. I'll take a standard which you've done in intermediate as well. And if you remember accounting standard 10, which is on PPE, and the corresponding Ind AS is 16. The standard is absolutely similar what you've done in the ICAI in intermediate. Accounting standard 10, there is PPE, and Ind AS 16, that is again PPE. So I'm just trying to remind you of that standard. So let's take an example. Let's consider Ind AS 16, that is property, plant, equipment is the name of the standard. Trust me, when a company, applies an asset related standard, it is divided into various facets. Like for example, you will first of all read the definition of PPE. You first read a definition of PPE. What is a property, plant, equipment? Now hear me very carefully, because what I'm telling you, you might be hearing it for the first time. If a company meets a definition of PPE, you cannot reflect it as an asset in the balance sheet. You heard me correct. If you meet a definition of a property, plant, equipment, it cannot be reflected as an asset in the balance sheet. Along with the definition, you also need to meet what we've got a recognition criteria. You also need to meet what we call a recognition criteria. A company needs to meet both the definition and the recognition. Only then it can be recognized as an asset in the balance sheet of the company. If you meet the definition, you fail the recognition criteria, it cannot be reflected as an asset in the balance sheet. You need to decide that definition is met and the recognition criteria is met. Then it appears in the balance sheet as an asset. Number one. So there are two things a company needs to decide. Can it be recognized in the balance sheet? Your balance sheet is like a menu card where you've got on the left-hand side the name of the asset, and on the right-hand side the rate list, the amount at which the asset appears. Trust me, for me, a balance sheet looks like exactly a menu card, where on the left-hand side you've got an asset, and on the right-hand side you've got the rate list. So once you decide it can appear on the left-hand side, it can appear as an asset, the next thing is to decide that what is the value at which the asset will be measured. So you start looking into measurement. In terms of measurement, you start deciding that there is an initial measurement of the asset. In terms of PPE, you know that it is measured at cost. In terms of the subsequent measurement, in terms of the subsequent measurement, it is taken at a cost or a revaluation model. I'm just trying to remind you what you've done at the intermediate level. So you first decide, can it be shown as an asset in the balance sheet? You meet a definition and a recognition criteria. And then you decide what is the value at which it would appear in the balance sheet of the company. Initially, it's recorded at a cost. Subsequently, it is at cost or a revaluation model. Once you've decided the measurement, then there are other parameters like you decide depreciation, etc. But then the standard talks about the presentation. How it will be presented in the financial statements. The presentation will be in terms of financial statements, the balance sheet, and the profit and loss. And then the standard gives you the next input, and that is called disclosures. This is how the standards gets organized, That is how the standard on asset related is organized. It gives you the definition and the recognition criteria, which helps you to decide, can it be shown in the balance sheet as an asset or not? Then you decide the measurement, what is the value at which it would appear initially and on the balance sheet date. Then how do you present it in the balance sheet P&L and the disclosures? The disclosures are done in the notes to accounts. Let me now start giving you some examples. I'll give you a number of examples to understand. But let's first take examples on Ind AS 16. Hear me very carefully, friends, now. A company makes a policy, let's say it's a big company, and it makes a policy that any asset which I buy for 5,000 rupees or less, I'm not going to capitalize it. A company makes a decision that if I am going to buy any asset which is 5,000 rupees or less, I'm going to put it in the profit and loss account. Now, please hear me carefully. They are deciding whether to recognize it as an asset or not to recognize it as an asset. They are taking a call to decide, do we recognize it as an asset or do we not recognize as an asset? When you take a choice on a recognition principle, you're going to recognize it or not. Because if a company decides a choice, if you get a choice in the recognition area, you say, okay, I'm going to recognize it as an asset, and I'm not going to recognize as an asset, but treat it as a revenue expenditure. So when you get a choice in the recognition area, it is an accounting policy. Number two, as you can see that in terms of the subsequent measurement, the asset can be taken at cost or revaluation model. Is it again a choice? Trust me, ये जो choice का खेल है, ये करूं या वो करूं, I do this or I do that. The choice in a measurement area indicates an accounting policy. The choice has to be in the area of recognition. If you show it as an asset, the profits of the company will be different. If you show it as a revenue expenditure, the profits are going to be different. So the company chooses a policy that 5,000 rupees or less, profit and loss account. You are deciding whether to recognize it as an asset or liability, whether to recognize it as an income or expense. So a choice in the recognition area gives rise to an accounting policy. The company is deciding that you're going to measure it in the balance sheet of the company at cost or at a revaluation model. It's again a choice. Should I measure at cost or should I measure at a fair value? That is a revaluation. The choice is an accounting policy. But let me also tell you, every time a choice may not be an accounting policy. I'll give you examples of that later. Next. Let us say I get a choice in terms of presentation area. Let me remind you in terms of this PPE. If you remember in the intermediate level, you did a concept when a government gives you a grant and it's an asset related grant, you might remember that there is a deductive approach and there is an income approach. When the government gives you a grant on the asset, you can either reduce it from the asset, one, and present it net in the balance sheet. Or you can take that grant and show it as a deferred income on the liability side. So when you get a choice, are you going to present the asset gross? You get a government grant, you're going to show that government grant on the liability side, present the asset at a gross figure and show the grant on the liability side, or you're going to show a asset net of government grant. It's a presentation choice. Trust me, we're not looking at disclosures. There are no choices in terms of disclosures. Accounting policies will arise only under three areas. When you get choices in recognition, when you get choices in measurements, and when you get choices in presentations. So can you take some more examples and we can decide that this is a recognition choice, this is a measurement choice, and this is a presentation choice. Yes, of course, we'll do that. But remember one thing, accounting policies will arise generally when you get choices. Ye karu ya wo karu. I do like this, I do like that. So when you make a recognition choice in terms of that, do we recognize it as an asset or not? Recognition choice. When you look at a measurement choice, do we measure it at a cost or a fair value? Measurement choice. Do we present it as gross in the balance sheet or net in the balance sheet? It's a presentation choice. When you get choices in these areas, recognition, measurement, presentation, it becomes an accounting policy. But having said that, let me also make one more thing absolutely clear to you. It doesn't mean, please don't keep the misconception. Please don't keep the misconception that only choices will give rise to accounting policy. For example, when you measure the inventory, there is an accounting principle. When you measure the inventory, there is an accounting principle that inventory is to be measured at cost or NRV, whichever is less. It's not a matter of choice. It's not a matter of choice. So it doesn't mean that choices will lead to, accounting policy. But most of the areas, when the company gets a choice, it's an accounting policy. But having said that, even accounting principles are supposed to be a case of accounting policy. Another biggest misconception which people have got is regarding the depreciation. Let me ask you that question. Is depreciation an accounting policy? Getting a choice between a straight line method and a WDV, is that a choice of accounting policy? Let's get your inputs on that, friends. Let's see what do you get on this. When a company is considering a depreciation based on a straight line or a WDV, is that the choice of a depreciation method going to be an accounting policy? Let's get your inputs on that. Let's see what is the viewpoint on this. We're looking at a depreciation. We're looking at a depreciation method that if a company chooses a straight line or a WDV method, is that going to be an accounting policy or not? Okay, I got the right answer. So no, it's an estimation. That's right. But let's give you more clarity. Can I say a company will charge a depreciation based on the pattern in which economic benefits arise? The pattern in which future economic benefits would arise. When you look at a depreciation, we consider that the machine is going to give you a benefits in what form? So over a period of time, let's say this is a graph. So we say that the economic benefits, the future economic benefits are expected to be in a straight line. So when you estimate that the future economic benefits will flow on a straight line, we prefer the depreciation on straight line method. Because what do? When you make your profit and loss account, you get a revenue on one hand and you claim a depreciation on the other hand. The revenue which you are generating is like the future economic benefits. So if the company expects, mind the words carefully, if the company expects that the benefits will come on a straight line basis, the depreciation is also taken on a straight line so that we are able to match the revenue and the cost. Because my accounting is based on matching of cost and revenue principle. On the other hand, let's imagine that the company believes that the economic benefits will keep declining as the time will pass. My machine is going to be technologically obsolete, so the benefits which I'm going to derive as the time period will fall down, I'm expecting that in this particular case, the benefits will fall down. So if the benefits is going to fall down, that means if the economic benefits will decline over a period of time, my depreciation method should be WDV. So depreciation is a reflection of how the economic benefits will flow. If the economic benefits are expected to move constant. We take a straight line. If the economic benefits are going to diminish over a period of time, then it is WDV method. Let's do one exercise, friends, now. I'm going to create a chart where you can help me in between, and we're going to decide that is this an accounting policy or not. When we're going to decide it's an accounting policy, you are going to take the input number 1. Is it a recognition choice? Is it a measurement choice? Or is it a presentation choice? Or is it an accounting principle? There are only 4 possibilities when you conclude that it's an accounting policy. Number 1, you say there is a recognition choice. Do we recognize an asset or not? It's a measurement choice. Do we take it at cost or a fair value? And how do we present it in the balance sheet or the income statement, gross or net? And if it is an accounting principle, these are the only 4 concrete areas of accounting policy. Let's do one thing. I'm now going to take some examples with you, and we're going to decide, is it an accounting policy? Number 1. And number 2, is it a case of a recognition choice, measurement choice, or a presentation choice? Let's begin. So let's begin the journey. I am now going to give you some examples. And in between, if you want, you can give your answers. I'll give you a break after we're done with these examples. No worry, we'll give you a break after that. So in terms of the examples, I'm giving you number 1. If you look at the lease standard, the lease standard is Ind AS 116. You're yet to study. You're yet to study, but we want to get the inputs today. When you look at a lease standard, there are certain cases, mind the words carefully, there are certain cases when the standard says you can either reflect the asset in the balance sheet or you may not reflect the asset in the balance sheet. So there are certain cases in Ind AS 116 where the standard says, in this case, if you want, you can show it as an asset. If you don't want, you don't show it as an asset. The question arises, is it an accounting policy? You're getting a choice to recognize an asset or not. Is it an accounting policy? Yes. And can we decide, is this a recognition choice, a measurement choice? It's a recognition choice. The standard says you've got a choice to recognize it as an asset or not to recognize it as an asset. So we can say it's a recognition choice. It is a recognition choice. And if it is a recognition choice, in this particular case, we can say it is undoubtedly an accounting policy. Let's take more example. Right now, we said in terms of Ind AS 16, this was 116 leases. I'm looking at Ind AS 16, that is property, plant, equipment. I'm looking at PPE in this particular case, and I think I'm getting wonderful answers. Yes, it is a recognition criteria. You're right, Mohammed, absolutely. You said right, it is operating. What you said is correct. In terms of Ind AS 16, the standard says that on the balance sheet date, you can either measure it at a cost or a fair value. You've got a choice. Is that an accounting policy? Since you've got a choice, yes, it is an accounting policy. And this choice has to be with reference to what? It's a measurement choice. It's a measurement choice. Either you reflect the asset at a cost value or at a fair value. It's a measurement choice. It's an accounting policy. Let's take another example. You get a government grant that is under Ind AS 20. You get a government grant that is under Ind AS 20. Like AS 12, you got a government grant as well. And in terms of the government grant, when you get a grant for an asset in the balance sheet, either you can show the asset at a gross value and show the deferred income separately, or you can show the asset at a net value, reducing the grant from the value of the asset. In this particular case, is that an accounting policy? Yes, undoubtedly, it is an accounting policy. Superb. And if it is an accounting policy, what is this? This is a presentation choice in the balance sheet. It's a presentation choice in the balance sheet, where we're deciding that it is to be presented at a gross value with a grant as a liability, or is it going to be presented net in the balance sheet? Let me also take another one, that you've got a depreciation method. You got a depreciation method. Either we take a straight line or we take a WDV. Is that an accounting policy? Of course, we said no. Because this is not supposed to be a choice in terms of policy. It is neither a recognition choice, neither a measurement choice, neither a presentation choice. It is purely an accounting estimate. It is purely an accounting estimate. Wow. So I think I've given you a couple of examples, a chart, so that you're clear on the parameters of deciding whether it is an accounting policy or not. So next time when you look at things, you got some more concrete data. I'm sure what I told you today on the parameters of deciding, how do you decide it's an accounting policy? I hope you're pretty clear now today. You know that when you're looking at an accounting policy, you're looking at the fact number one, is it a recognition choice? Should we show the asset or not? A measurement choice at this value or that value, and the presentation gross in the balance sheet, net in the balance sheet. So this is recognition, measurement, and a presentation choice. Apart from the accounting principle, they are supposed to be accounting policy. Right, friends, so far so good. I guess you've all understood that pretty well. Okay, I think it's time to give you some break as well. I'm sure you'll need one. Oh, this is quite, good. We've covered almost quite a bit, almost 7:50. I think 10 minutes quick break would do. Then I think let's start a journey on the accounting policies further, right? So let's give you a 10 minutes break, friends, and then we meet after the break with you. Relax your minds in the break. See you after 10 minutes, friends. Welcome back, friends. I hope you had a relaxing break. So let's take the journey forward. Let me see if there are still any questions coming in. Okay, I think clear so far. That's wonderful indeed. Okay, so let's take the journey forward now. So we have understood what is an accounting policy. And now I need to take you further and understand in terms of, can a company change the accounting policy? And if yes, what are the circumstances when you can change the accounting policy? And number two, when the change is going to occur, how would you account for it? So let's take it further. Now we're looking at the second issue, and that is, can a company change the accounting policy? The question is, can the company change the accounting policy? Well, let me put it like this, that there are two aspects when a company can change the accounting policy. One is what we call mandatory, and the other one is what is called optional. A company is asked by force to change, that is mandatory. And the company is required to change, it changes the accounting policy purely on account of a voluntary choice. So we can say that a company can change the accounting policy. There are only two valid reasons when a company can change. One is called a mandatory change, and the other one is called a voluntary change. So the company can change an accounting policy. So we can say there are two parameters, or you can say two situations when a company can change an accounting policy. One is what we say that it is mandatory. Now, when do we say that it is mandatory? I mean, just taking an example. Let's say, for example, we have got Ind AS 16 property plant equipment, which gives you a choice that a company can measure the asset at a cost or at a fair value. Let's say tomorrow the standard setters make a change and they say that you're not allowed to use a fair value model. So the moment they make a change, it is mandated for every company that no company will be able to apply a revaluation model. So mandatory is when it is required by a particular Ind AS. So when there is a change which is made to any particular standard, when any standard undergoes a change and the standard says that from today onwards, you cannot do this, no company will be allowed to, do that. In that case, it becomes a mandatory change. Mind you, I said required by Ind AS. I never said that it is required by law. When you were in the CA intermediate and you did accounting standard 5, you understood that there were three reasons when a change can be made in accounting policy. You said when the change is required by statute, and that is called law. In terms of Ind AS 8, there is nothing called a change required by law. A mandatory change happens only when the change is required by Ind AS, not by law. Second, we said it's a voluntary change. Now, when I say it's a voluntary change, what does a voluntary change mean? It means the company feels, the company evaluates that it would result in a better presentation of financial statements. They have reasons to believe that it would lead to a better presentation of financial statements. For example, I'll tell you. Let's say there are many companies in the industry, and all the companies in the industry, all the competitors in the industry are using, let's say, a revaluation model for a PPE. But my company is applying a cost model. When you compare your financial statements, when you compare your performance, you need to compare your performance with the competitors in the industry. Do you think you'll be able to make a comparison if you are using a cost model to measure and the other companies in the industry are considering a revaluation model? No. So in this particular case, to make my financial statements more comparable with the other competitors in the industry, I feel it's going to be a better presentation. So I also want to follow those policies which my competitors are following in the market. So in this particular case, it results in a better presentation. I choose to make a change in policy. So either I'm forced, that is called mandatory. There is a change in a particular Ind AS and it prohibits you to follow a particular policy. So if you're following a certain policy and the standard prohibits you, you need to change the policy. Or the second one is that it's a voluntary change that the company feels to make the financial statements more reliable, relevant, more comparable to the other competitors in the industry. I can make a voluntary change. The company needs to justify. When you're going to make a voluntary change, the company will have to make a justification. You will have to justify why did you change a policy. But these are the only two parameters where a company can change an accounting policy, either by force, where the standard says, stop doing this, start doing this. Or it is a choice when the company feels that in order to make things more comparable with the competitors, you want to make changes. These are the only two circumstances. So I think the second question gets answered when a company can change an accounting policy. Next. The question now arises that if you change an accounting policy, what do we do now? If you change the accounting policy, what is the accounting? Please watch this very carefully, friends. What I'm about to give you, see this very carefully. Okay, I got a question from Hetal. So why method of depreciation is an estimate and not accounting method? I'm still not clear on this. But when you're looking at the concept of depreciation, remember what I said. The company takes a revenue on one side in the P&L, that's one, and the company takes a depreciation on the revenue. Now, you are generating revenue and you are putting a depreciation as an expense to generate that revenue. You know, when you consider a cost of goods sold, remember, when you consider the concept of cost of goods sold, let me now tell you something on this. So when you say that this is the revenue and this is the cost of generating the revenue, that is depreciation. You need to match the cost and the revenue. If I know that the revenue is going to arise constant, the company will get the revenue on a constant basis, straight line. Then correspondingly, the depreciation should be also constant, then use a straight line method. The pattern in which the economic benefits are expected to arise. Mind the words, I said the pattern in which the economic benefits are expected to arrive is constant. But let's say the machine which you're using is going to decrease the economic benefits because the technology will become obsolete. So today, when you're going to produce items with that machine, the revenue will slowly and steadily coming down. If it's going to come down, then in order to match the declining in revenue, you should use a WDV. I hope I'm clear on that, right? So I can't hear Alicia. Please, maybe you'll have to re-log in. Am I clearly audible, I guess, friends? I'm not getting any of the messages on that. Okay, very much indeed. Okay, so Hetal, you got your answer right on this. So basically, your expected pattern, this is, the expectation. You estimate the pattern of economic benefits. You estimate the pattern of economic benefits. And when you estimate the pattern of economic benefits, the depreciation also becomes an estimation to that extent. Because depreciation is a representation of how the economic benefits will flow to the company. If they expect the benefits to be constant, SLM. Diminishing over a period of time, WDV makes sense. Okay, now fine. I think, Alicia, great. Okay, everybody, I think, Hetal, you got your answer on that, right? Okay, so now let's take it further. I'm now coming to the third question in terms of accounting policy, that if you're going to change the accounting policy, what do we do? Let me just remind you back again. Now, this is crucial. In the next 15-20 minutes, you get a complete understanding of the concept. I may not be able to do much questions with you on this area because we need to finish these standards within this one class itself. So, I may not be able to because of the constraint in time, cover up the entire things with practical examples and all. But conceptually, I'm going to give you the entire inputs on this. There were three questions with reference to accounting policy. The first is, what is an accounting policy? I gave you very clear cut that accounting policy means choices in the recognition area, in the measurement area, and in the presentation area, or it can even be an accounting principle, which is not a choice, but it is a principle. Inventory is taken at cost or NRV, whichever is less. Then we said, can we change an accounting policy? I said, one is by force. The Indian accounting standard prohibits a particular policy. You need to change the policy. It's mandated. Or you can make a change because you feel that your competitors in the industry follow a particular policy to make your financial statements comparable. You want to make a change. That's a voluntary change. But you need to justify in the notes to accounts, why did the company change a policy? What are the reasons of, making that voluntary change? Now, once the company makes a change, now see what we are going to do. So have a look at this very carefully. Let's take a time scale and watch this very carefully, because I'm going to introduce a concept, what you might have done in Ind AS 1 along with this. Let's consider on a time scale, year 1, year 2, as well as year 3. Let us say this is the current year. Let's consider 22-23. April to March is the financial year. This is the previous year, that is 21-22. And this is a year prior to previous years. This is the years which are prior to the previous years. Let's consider this date as 1st April 2016. Let's consider this date to be 1st April 2016. Now, I'll go a little slow, but hear me very carefully on this. Let us say the company decided on 1st April 16 that inventory is going to be measured on the basis of first in, first out. Let us say on 1st April 16, this is the first time the company applied a policy. When you're considering the inventory is taken at cost or NRV, that is an accounting principle. It's an accounting policy. Whether the cost will be taken on a FIFO or a weighted average is also an extended part of the policy. I repeat, when a company is considering the inventory at cost or NRV, whichever is less, it's an accounting principle. And when, as a part of the principle, you decide to consider inventory at cost, that is FIFO or weighted average, it's a part of the accounting policy. So the company on 1st April 16 decided it will apply first in, first out. So they continue to apply FIFO. They continue to apply FIFO till the last year, that is till the previous year. Now they decided to do a change, and let's consider that it was a voluntary change, and the company decided that they are now going to measure the inventory using a weighted average. Is that a change in policy? Yes. So the company was following a first in, first out from 1st April 16, and now they've decided in the current year to apply a weighted average concept. It is undoubtedly a case of change in policy, and I am considering that this change in policy is supposed to be something which is voluntary in nature. Now, let's see the implications in terms of accounting. I am sitting in the current year making my financial statements. So when you're going to make the financial statements of this year, you will make them on the basis of weighted average. Undoubtedly, you're going to follow the new accounting policy itself, and you will consider your balance sheet, your profit and loss, everything is going to be taken on the basis of weighted average. Your income statement will take the stock valuations. Your balance sheet will take the stock valuations based on a weighted average concept. 1. Now, what do I need to do? When a company presents a financial statements, it needs to present a financial statement for the current year, and they need to present a comparator. and that is a previous year financial. Every company in a practical life scenario will present the financial statements for the current year, and they are also going to present the financial statements for the previous year comparatives as well. So when they're going to present it based on the previous year comparatives, you've already made the financial statements on FIFO. The standard requires a retrospective application. So what you need to do, you need to now use a weighted average and restate the financial statements. So you mean to say that I'm going to make a new income statement and a new balance sheet based on the new accounting policy? Yes. The company is going to make a complete restated balance sheet and a P&L for the previous year comparative as well. The change is made in this year, but you need to also make a change on the comparatives as well. The previous year financial statements, which were originally based on FIFO, now needs to be restated on the basis of weighted average so that the shareholder can make a comparison between the two financial statements. But it doesn't end out here. It doesn't end out here. Now see another thing. Once you make the financial statements for the previous year, you might be knowing that financial statements would mean a balance sheet and its accompanying document, which is called SOCI, Statement of Changes in Other Equity. So we look at the statement of changes in equity. So when you present a balance sheet, there is an other equity in the balance sheet, and in the other equity, you give an explanation in the SOCI statement as well. Now, I'm looking at 21-22. So when I'm looking at 21-22, now see what we're going to do carefully. Don't worry, I'll repeat the entire process. Now see this again. When you're going to present the previous year financial statements, you're going to make a statement of changes in equity that is SOCI. I guess, friends, you're already aware that the SOCI has got 3 tabs, right? I guess you know that there are 3 tabs in a SOCI. You've already covered the concept of SOCI, right? Can I comfortably consider that you know the SOCI concept? Okay, can we also conclude that it is related to profit and loss and it's therefore accounting estimates? No, we can't say that balance sheet items are accounting policy. We can't really say that. There can be a couple of examples of items related to P&L, but they may be accounting policy. Okay, so you've covered that. Okay, wonderful indeed. So SOCI has got a total of 3 tabs, and if you remember, the middle tab is called the reserve and surplus, in which you've got a retained earnings. So what the company would do, they will consider the balance on 1st April 21. When you're going to make a SOCI for this year, you're going to consider this is, let's say, the retained earnings column. I'm looking at the retained earning column. So you're going to consider the balance on 1st April 21. I'm looking at 21-22. So you will take the balance on 1st April 21. And to this, you will add the profit for the year 21-22. That's how you're going to get the balances. Now, the question arises, when you take this opening balance, should it be based on FIFO or should it be based on a weighted average? It should be based on a weighted average. So you mean to say that now you will calculate that if the company would have applied a weighted average from April 16 to March 21, if the company would have applied a weighted average from 1st April 16 to March 21, I need to know the opening balance based on that. Yes. So I will tell the company to restate this balance, to change this balance, restate this balance based on weighted average. You need to restate this balance based on a weighted average. I'll give you the example to make it more clear. So let me just consolidate the inputs once. A company decided to change the accounting policy. Please hear this very carefully indeed. The company decided to change its accounting policy. The current year financial statements based on the new policy, undoubtedly. The previous year financial statements will be restated and you will follow the new policy itself. So current year based on new policy, previous year comparative, originally based on old policy, need to be restated based on a new policy. And when you're going to make the previous year financials, along with the balance sheet on March 22, you're also going to present a statement of changes in other equity. So in this particular case, see, if I show you in detail, when you're going to make a statement of changes in equity, you're going to take the balance on, 1st April 21. Let me take it back. You're going to consider the balance on 1st April 21. This is the opening balance of retained earnings. This is the opening balance of retained earnings, which is there. This opening balance in the books of accounts is based on first in, first out. Because the company has followed the FIFO on the previous years. So this opening balance is based on a first in, first out. Now, what do you need to do? I need to consider the impact of change in accounting policy. Now, hear this very carefully, what I will do in order to calculate the impact of the change in accounting policy. Now, watch this carefully. From 1st April 16 till March 21, from 1st April 16 till March 21, the company from 1st April 16 to March 21, can I say they would have applied a first in, first out. Let's see what is the profits of the company for this entire block. See what is the profits you've computed for 16, 17, 17, 18 till the end of 2021 and see what is the profits based on FIFO. Then again, recompute that what would have been the profits if you would have followed for this block a weighted average. See, if you would have applied a weighted average, then what would have been the position of profits? Now you need to consider the difference. You need to consider the difference and make the changes to the opening balance. I want the opening balance in such a way, if you would have applied the accounting policy from 1st April 16 onwards, what would have been the opening balance on 1st April 21? So I will tell the company that please make a retrospective calculations. This is the balance based on that you followed a FIFO. Give me a balance which would have been, had there been a weighted average and you would have taken the weighted average from the very inception on 1st April 16. So whatever is the difference in the profits, adjust that difference and get what we call restated balance. And get what we call a restated balance, which is on 1st April 21. You're going to get a restated balance. This restated balance is going to be based on a weighted average. This is called retrospective accounting, and I sometimes say it is a full retrospective accounting. That the company will have to make the changes as if the new policy had been in application from the very inception itself. So, but there could be reasons when a company is not in a position to do a retrospective accounting. Can there be impracticability of not applying a retrospective accounting? Possible. The standard also addresses that if there is impracticability, then you can do the restatement from whichever point you can. Let's say, for example, in the year 1617, a fire occurred and all my records have been destroyed. And I don't have the information for the year 1617. No issues. You do the restatement from 1st April 17 till March 21. Now you might say, sir, it is impractical for the company. I can't get any information from April 16 to March 21. Then do we apply it on a prospective basis? Well, if it is completely impracticable, that the company is not able to get any information of doing a retrospective accounting, which is full, or a retrospective accounting from a date where you can make changes, then I can't do a retrospective accounting. In those extreme cases, a prospective accounting would be applied. So in an idealistic situation, the company needs to go in for a full retrospective. But if there is impracticability, the company, due to any general reasons, is not able to do it on a retrospective basis, do it from wherever you can. If the company cannot do any retrospective accounting, then even in those limited cases, a prospective accounting is possible. And after this, you are going to add the profit for the year 21-22. You're going to add the profit for 21-22, which you already have in the restated P&L. And in this particular case, you are going to take the restated profits in this case. And that's how you're going to get the balance, which is there on 31st March 22. So this is what you'll have to do in the statement of changes in equity for the previous year. And the journey doesn't end at this place. So you'll have to put this once again to us. This seems to be quite complicated. No worry, I will consolidate this to you. Let me say another thing, then I'll consolidate the learnings on the accounting part. Now, one more thing which you need to keep in mind. If a company, please hear the words carefully, if a company makes a change in policy, if a company makes a change in policy, I'm giving you something very important, which is based on Ind AS 1. It is based on Ind AS 1. If a company makes a change in policy, number one, ask yourself a question: does it have an impact on the asset and liability? Question number one, you need to see, does it have an impact on the asset and liability? I didn't say income and expense. I didn't say income and expense. Does it have an impact on the asset and liability? Number one. Number two is the impact material. Number two is the impact material. So you need to ask yourself two questions in this case. When a company made a change in the policy, is this going to impact the asset or liability balance sheet? And the impact is material, then Ind AS 1 tells me, you need to make a third balance sheet as well. This third balance sheet is going to be prepared on 1st April 21. This balance sheet is going to be made on 1st April 21 only if the accounting policy has got an impact on the asset liability. If it doesn't have the impact on asset liability, no third balance sheet. You're not going to make an entire set of financial statements, only a third balance sheet. No P&L is going to be prepared. Only a third balance sheet will be prepared. One balance sheet at the end of current year, one balance sheet at the end of previous year, and one balance sheet at the beginning of the previous year. Sir, once more, you need to tell us once more on these agendas. Okay, Alicia, you've got a question. So why on 1st April 16, it is from the date of incorporation? Well, I have taken the example that the company, let's say, started applying that policy on April 16, which is technically, yes, I am considering the date when the company got incorporated, of course. So let me now consolidate the journey once again so that you're able to understand the accounting treatment for a change in policy. Let me consolidate the learning. So I'm now going to come back to this example. Let's have a clear understanding of this. I know it's a little technical. I would have taken up a practical example to explain things as well, but then, we can't have that much time. So I think keeping the time factor, I'm just giving you a conceptual knowledge on what is the accounting treatment. So let me take it further. Now remember, when there is a change in accounting policy, it has to be retrospective. How does a retrospective accounting take place? Current year financials based on the new policy, 1. previous year financials based on the new policy to be restated because you've already made previous year. I'm yet to make the current year. Current year is based on the new policy, one. The previous year financial statements complete set is going to be restated based on the new policy. So current year, new policy, previous year financials restated as per new policy, 2. 3. As a part of the previous year financials, when you go to present your balance sheet on 22, your balance sheet will also be accompanied by SOKI. Your balance sheet is also going to be accompanied by a SOKI. So when you're going to present a SOKI, a statement of changes in equity, this is for the year. This is for the previous year. You're presenting the SOKI for the year 21-22. So you will take an opening balance on 1st April 21. This opening balance on 1st April 21 is based on a first in, first out because the company had been applying a FIFO basis in the previous years. So your opening balance in the books of accounts is based on a FIFO. You need to change this opening balance on a weighted average, and that is called a restatement. So what will I do? I will ask myself a question that you started valuing the inventory on 1st April 16, for example, on a FIFO. So the company calculated the profits of 16-17, 17-18 till 2021. Each of these profits from 1670 to 2021 is taken on a first in, first out. Recompute that if you would have taken the profits of these blocks instead of FIFO, you would have taken a weighted average. What would have been the opening balance? So you know that this is the profits based on FIFO for all these years. If you were to take a weighted average, what would have been the profit? Compare the two and plus or minus, whatever the case might be, adjust the difference. So that I am able to change this balance, I'm able to change this balance and bring a restated balance on this date. You need to convert this balance into a restated balance on 1st April 21, as if the new policy would have been applied from the very inception on 1st April 16. And to this, you add the profits for the previous year, which is again based on restated financials. So this is what you need to do in the previous year SOKI. So sometimes the examiner would ask you only an inputs. He will say, okay, do one thing. Give me the current year income statement, no balance sheet. If you look at the questions in the study material, they're very clear that they've given you questions to make an income statement for the current year based on the new policy. You make an income statement of the previous year based on the new policy. That's it. And further, what you need to do in this particular case, I'm gone back, sorry. And what you need to do further, he will ask you only retained earnings column. He will not ask you the entire SOKI. He will just say, give me a restated retained earning column for SOKI. That's it. But I've also added another 4th item, which is on account of Ind AS 1. So number 1, current year financials, new policy. Previous year restated financials, new policy. Number 3, accompanying SOKI document to be restated. And number 4. This is number 4. If you change the accounting policy, it has got an impact on the asset or liability, not income and expense. And it has got a material impact. You're also required to make a balance sheet at the beginning of the previous year. You're also required to make a balance sheet at the beginning of the previous year. So 4 things to be remembered. When a company makes a change in the policy, number 1, current year based on new policy. Previous year financials restated based on new policy. In the previous year financials, the balance sheet accompanies the SOKI, restate the opening balance of the previous year. And number 4, if this change has got a material impact, 1, on the balance sheet item, 2, you need to make a 3rd balance sheet as well. You need to give a balance sheet at the beginning of the previous year as well. I hope I am pretty clear so far on this particular agenda, right? I guess I got the input clear. Everybody's clear, friends, on the accounting treatment with a retrospective effect. Okay. This was on the accounting policy. 3 agendas done. Number 1, what is an accounting policy? Done. When can you change the accounting policy? Done. Number 3, what is the accounting treatment for the change in policy? Done. Now, let's go to the next agenda. And we are looking in terms of changes. We are looking at changes in accounting estimates. We're looking at changes in accounting estimates. So we now need to understand the second aspect of this. Okay, I think, Alicia, you've got a question. Practically a lot of work before changing the policies. Company need to think 10 times. Yes, of course. You're absolutely correct. Because we don't want companies to make changes in policies so frequently. So you can indirectly say that it is indirectly penalizing the company, that you think 10 times before you do that. You're absolutely correct. That was, absolutely a correct observation indeed. We are indirectly discouraging because companies need to follow accounting policies consistently year by year. And if they're making changes on a voluntary basis, they better be sure that there is going to be a lot of homework they need to do if they want to make changes in accounting policy. And apart from all this, you need to do a lot of disclosures in the notes to account as well, which I did not mention. But of course, that is another 5th item to be done as well. Okay, that's great. Now let's take you further on the next aspect, that is changes in accounting estimate, which is not at all difficult. I said I'm not going to expose you on the concept of the definition, but I'm just going to give you some examples of accounting estimates. I'm going to give you examples of accounting estimates, and there can be numerous number of examples. We just took one of them, depreciation method. When you depreciate the asset, you consider a useful life. Is that an estimation? Yes. When you consider a depreciation, you consider a scrap value. Is that an estimation? Yes. So when you're considering the examples, we can say the estimation of the useful life is an estimation. You estimate that what is the expected life, the useful life of the asset for depreciation. When you consider the depreciation, you take a scrap value of the asset. That is again an estimation. When you consider the method of depreciation or maybe the method of amortization for intangibles, that is again an estimation. Is calculating the fair value of the asset is an estimation? Yes. When you consider the fair value of a particular asset, it is again an estimation because that's again based on a set of assumptions. So when a company makes a change in the fair value, remember what you do. You never do a retrospective accounting. Even in terms of accounting standard 10, that is Ind AS 16, what you're going to study, if you make a change in the fair value of the asset, you revalue the asset again at a later balance sheet date, you again revalue the asset, the change in the fair value is accounted on a prospective basis. The fair valuation is again an estimation. The provision for doubtful debts. The provision for doubtful debts is again based on an estimation. And any changes in these estimates will always be accounted with a prospective effect. We're never going to change anything in the previous year. So I said, I'll give you examples. Number 1, these are the examples of estimate change, but this is not an exhaustive list. It is purely illustrative in nature. I've just given you a few examples of what are the various examples of the estimate things. Second, I said, if there is a change in estimate, in this particular case, do we change the estimation? I said, yes. If there is a change, we should definitely incorporate the change. Because if new information has come into place, additional information has come, you change the estimation. So the change occurs because you get new info. The change occurs because there is additional info. You get new information, additional info related to what you had. So this would mean that yes, you should definitely account for the change. And the question arises, how would you go for accounting of this change? Prospective. Let's take an example, which you've done, couple of times, even when you were in CA Foundation. You would have done this couple of times, even when you were in graduation. If some of you have done graduation or some of you have done through foundation level, you would have seen a couple of examples. So this is going to be prospective. Let's give you an example. Maybe you can help me in deciding the answer. Let's take a very basic example. And I think let's put across that question to you. Let's see. Let us say the cost of the asset is 10 lakh and the scrap value of the asset is, let's say, 2 lakhs, and the life of the asset is, let's say, 10 years. And I'm using a straight line depreciation. So very simple example I'm considering. Let's say the cost of the asset is 10, the scrap value is 2 lakh, and there is a 10 years life, and I'm using a straight line depreciation. Let me calculate the depreciation per annum. So we can say the depreciation will be cost minus the scrap divided by the life, which is 10 years. So we're going to get a depreciation 80,000 per annum. The depreciable amount of the asset is supposed to be 8 lakh and that is spread over the useful life. So we get a depreciation 80,000. Now let's consider one thing. Let us consider that I want the book value of the asset, let's say, after 4th year end. I want, let's say, the book value of the asset after the 4th year end. So after the 4 years, I want the book value of the asset. So it's going to be 10 lakh is the cost. 80,000 is the depreciation taken for a period of 4 years. So we can easily get the book value of the asset after a period of 4 years. So we can say 80,000 into 4, 3.2. So we can say the book value of the asset is 6.8 lakh. Now, let me ask you a very simple question, and I think you can easily give me the answer on this. Let us say at this stage, there are certain changes in the estimation. Let us say at this stage, there are changes in the estimation. Now we are considering that the scrap value, is become, let us say, to the extent of 0.8 lakhs. The scrap value has undergone a change at the end of the 4th year. Would you like to give me what is the depreciation on a per annum basis? Let's see if we can get this answer from you. So in this particular case, if the scrap value of the asset changes, would you like to tell me what is going to be the depreciation which is going to change on a prospective basis after this change is done? Right, it's going to be simple. Whatever is the book value of the asset minus the scrap value to get the new depreciable amount. So what we're going to do, the book value of the asset is 6.8 minus the new scrap value, that is 0.8, that becomes a depreciable amount. This depreciable amount is going to be spread over, can I say, the remaining life of the asset, which is supposed to be 6 years. So when you're going to consider the depreciation based on the new life, that's absolutely correct. 1 lakh becomes the depreciation. This is what prospective accounting is. Which means the company is going to recompute the depreciation based on the new method, based on the new estimations. You're going to consider the new depreciable amount and spread it over the remaining life, and you get the new depreciation. As simple as that. So does a change in accounting policy involves any restatement? Any restatement in terms of the previous year financials? No. Does it require you to make any restated SOCI balances? No. Does it require you to make a third balance sheet? No. Now something great is coming to my mind, friends. Accounting policy is done. Accounting estimates are done, and trust me, the correction of errors is got the same accounting what you've done in terms of accounting policy. I want to give you a wonderful chart at this stage, which gives you a comparative in terms of the accounting treatment That what is the accounting treatment when a change in policy is done retrospectively, when there is, let's say, a correction of errors, and when there is a change in estimation. I think that's going to make the life jingalala. You want me, friends, to give you a comparative chart? Ask for it. आप मांगेंगे तो मैं आपको दूंगा. So you want me to make a chart on that? Ask me, I'll give it to you. So tell me, I'm going to give you a chart. If you want that particular chart, I'll give you a comparative chart in terms of the accounting treatment, summarizing the components in terms of correction of errors, in terms of policy change, in terms of estimate change, which summarizes and gives you entire crux on things. And my friends, tell me, yes, just one yes. एक yes से motivation नहीं होती मेरे दोस्त. You need to give me a couple of yes on that before I give you that wonderful chart. So all of you want that particular chart summarizing the position of the accounting in this place. So far, I got just only one yes. Okay, so now I'm getting more yes on that. Yes, please. Yes, please. Okay, wonderful. Done. Let's begin. So let's give you that wonderful chart indeed, so that we are very clear on the accounting treatment in terms of things. So I'm going to take a column for particulars, a column for policy, a column for estimates, a column for correction of errors. Okay, let's, I think, begin with this and watch this carefully, because in terms of errors, I told you it can be intentional, it is unintentional. I've already given you that you need to rectify the errors in the material. The accounting treatment I'm going to summarize in this part. So let's begin. So let's take one column for particulars, and let's take one column for accounting policy. When you make a change in accounting policy, this is going to summarize the entire accounting treatment. This is going to summarize the entire accounting treatment in one particular chart. So let's consider accounting policy, then accounting estimates. And I'm going to introduce one small little complication as well. And let's consider this is rectification of errors, which is there. Now watch me carefully. If you're able to fill this chart with the permutation combinations I'm giving you, you will feel absolutely clear on the treatment. Then you just need to do some practice of the questions as well. So let's begin the journey. If you want to answer the questions in between, you're most welcome, friends, to do that. For convenience, I am now considering an base to understand. Let's do one thing. I am considering one particular example to understand the accounting. Let's give you a time scale, and we're going to fit in the time scale and see the accounting. This is current year 22-23. This is previous year 21-22. And this is prior to previous years. This is prior to previous years. Let's say it starts from 1st April 16. And this is 1st April 21. So let's keep this time scale and let's begin the journey. This is your current year, 22-23, previous year, and this is prior to the previous year. So for the accounting policy, I am considering that you started following the accounting policy FIFO out here, and in the current year, you decided a weighted average. For the purpose of accounting estimates, let's say you decided that you're going to consider a certain scrap value out here, and you made some changes on the scrap value, let's say in the current year. So let's consider that as a base. And number 3, I'm considering that let's say there is an error. Now I'm taking two cases. The error occurred, let's say in the year 16-17, and it is located in the current year. And I'm considering the error occurred, let's say in 21-22, and it is located in the current year. So two variations I'm going to consider. Watch this very carefully. You're going to get a complete clarity of thoughts on this. So let's say the error occurred in 1617, located in the current year, 2122, located in the current year. So these are the three agendas which I am covering. So let's take this as a base. You want to answer the questions in between, you're most welcome. Otherwise, I'm going to do the honors at this stage. Watch me carefully on these three things: accounting policy, scrap values for estimations, and the errors. I'm taking two cases. Let's begin. I'm looking at number one, the current year financial statements for the year 22-23. I'm looking at the previous year financial statements, that is 21-22. I'm looking at the SOKI being the retained earnings being restated. I'm looking at the SOKI being restated on 1st April 21. I'm looking at the concept of the third balance sheet, which I need to prepare on 1st April 21. So there are four things which we are looking at: the current year financials, the previous year financials, the SOKI to be restated on 1st April 21, and the third balance sheet on 1st April 21. In terms of errors, we've got two cases. The error happened in 1617 and the error happened in 21-22. So we've got two cases. Watch me, hear me, analyze me carefully for the next 7-8 minutes, and trust me, we're going to be done with this standard in the next 7-8 minutes. Let's begin the journey. I'm first concentrating on the aspect of accounting policy. Current year financials based on a weighted average, yes. Previous year financials to be restated on the basis of weighted average, yes. Opening balance of retained earnings to be restated as per the new policy, yes. A third balance sheet to be prepared, yes. If asset liability is affected, if it is material in nature, if asset and liability is affected and it is material in nature, I'm going to make a third balance sheet. This is exactly what we decided when we took the example earlier. Your current year financials based on new policy, your previous year financials restated as per new policy, opening balance for SOKI restated retained earnings, and you got to make a third balance sheet on 1st April 21 if it impacts the asset liability and the material impact is there. Great. Next, I'm going to look at accounting estimate. The current financial statements based on the new estimation, yes. The current year financials based on the new estimations, yes. Anything to be done on the previous financials, no change required. Any SOKI balance to be restated, no. Any third balance sheet required, no. Because it is a prospective accounting. So there is a prospective accounting, so only the new financials, the current year, based on the new estimate, rest nothing is to be touched. Now let's go to the next one, that is errors. Watch me carefully. The error took place in 1617, prior to the previous year, and it occurred in 21-22. This is previous year itself. This is prior to previous years. So there is going to be a slight difference in the answer. Now let's have a look at this particular aspect as well. The current year financials, are you going to rectify the error? Yes, in both the cases, we will rectify the error. We will consider the current year financials after making the rectifications. Are you going to restate the previous year financials? Yes. Are you going to restate the previous year financials? Yes. Correct them. correct the previous year financials based on the correction of errors. Both the cases rectify the errors in the previous year financials. So basically, you would restate the previous year financials and rectify the impact of the errors. Now, the SOKI balance on 1st April 21 to be restated. In this case, yes. Is the 1st April 21 balance required to be restated? The error occurred in 21-22. The balance on 1st April 21 cannot be restated, right? Because the error occurred in the previous year itself. So where is the question of changing the 1st April 21 balance? That is why intentionally I considered the concept that the error took place in the immediate previous year itself. If the error occurred in the previous year itself, then restatement of the opening SOKI not required. But if it occurred prior to the previous year, then restatements required. Next, a third balance sheet required in this case, yes. And let's ask you, friends, on this. And of course, this is based on those ifs that it is impacting the balance sheet and it is impacting its material in nature. Let's ask you a question now. Do you think a third balance sheet is going to be required in this particular case? Your error occurred on 21-22. So do you think we need a balance sheet on 1st April 21? If the error occurred in 21-22, does it impact the asset and liability of 21-22? So let me get the answers. What do you say? Yes or no? So what do you say? A yes or no? This is certainly going to be a no in this case, because if the error occurred in the prior year, previous year itself, if it occurred in the previous year itself, you can definitely see that it's not going to impact either the opening SOKI or the opening balance sheet would get triggered. The opening balance sheet will get triggered only in the cases when the error occurred in the prior to the previous year. I hope, friends, I am pretty clear on this. That was right answer given. So this is a comparative position in terms of how the accounting is going to take place when we are going to change policies, when we are going to change estimations, or when we're going to correct the errors. This is a summary view of the accounting. So I'm going to call this accounting treatment as my mind map. So that I think perfectly finishes our concept in the designated time itself. And I've done with Ind AS 10 and I've done with Ind AS 8. Of course, if you would have got more time, perhaps I would have done some practical questions with you. Nevertheless, what you need to do now, friends, with this concept in hand, you need to look into the study material and do some questions on this. Trust me, if you've got that conceptual clarity, doing the questions is not going to be a big challenge, because once you know that what is to be done at various places, especially this particular chart, is going to give you a good hand-on in terms of Ind AS 8. Right, friends, all the good things have come to an end as well, and all the bad things also come to an end in life. So are we done with the session for the day. It was a very interesting interaction with all of you, a lovely interaction, friends, with all of you. Hope you all enjoyed as well. And I think it was a learning with a lot of fun as well. So we learned a couple of things today in this 3-hour session. Hoping to see you soon on this. But not I guess in October. So hoping to see you soon on this. So if you got any questions, please tell me. And Vanshika, thank you so much for such an interesting and engaging class. Thank you, Vanshika. That's so nice so sweet of you, beta, on that. I think that gives me a good sleep for the day. So I think as the day comes to an end, I think I get a wonderful sleep with your good gesture as well. Shankara sir, your class was extraordinary. I've become a huge fan of yours. Oh my God, high caliber English, 3x3 matrix, your handwriting. Oh my God, you made my day equally well, beta. Thank you so much indeed for your lovely comments. That is the energizing capsule, which, people need, we people need. Your inputs, your things are, quite energizing. You don't need a revital energy for that. I think that's quite encouraging indeed. Okay, Alicia, extraordinary. That's wonderful indeed. Thank you, Alicia. But that's so much, so nice of you indeed. I think that makes my day wonderful indeed. So it was a pleasure teaching you all. So hope to see you soon on this, friends. So I think I'm going to take leave unless you've got some questions on hand. Otherwise, we're going to call it a day. So let's see if any questions further coming in. Right, friends. So I think that seems to be good for the day. So I think I'm going to take leave on that, friends, from you. Thank you very much. Bye-bye and take care. Thank you.